Hey everyone, welcome back to Corporate Decoder, the place where we dive into the nitty-gritty of corporate filings. Today we are looking at FT Vest Hedged Equity Income Funds Report. Now that name might sound a bit boring, but I promise it's packed with interesting info. I will decode those corporate reports for you. This fund is a cool twist on income investing, attempting to deliver a steadier return by hedging against market downturns while still providing regular income. So let's see if it's as smooth sailing as they claim, or if there are some hidden rocks beneath the surface. Before we begin, if you enjoy extracting clear insights from complex corporate documents, make sure you subscribe. Also, be part of the discussion in our Discord community using the link in the description below. Basically, what we're looking at today is a registration statement, kind of like a permission slip the company is asking from the SEC that was submitted in July of 2025. This document ensures they're playing by the rules before offering their investment product. It's called an N2 form, which is specifically for closed-end funds, meaning they don't constantly issue or redeem shares like typical mutual funds. Instead, shares are offered a limited time. The fund's name tells you a lot. This is all about generating income and protecting against losses. Hedged Equity Income Fund, but rather a subset of the series. It specifies shares are offered only to accredited investors. This isn't for everyone. To be accredited, you need to demonstrate a certain level of financial sophistication and net worth. This also means that they do not intend to trade on any popular platform. The fund aims to provide attractive risk-adjusted returns through a combination of a high level of current income and potential long-term capital appreciation, although with a focus on minimizing losses. They plan to achieve this by investing in US stocks of the S&P 500 index and using strategies to protect against market drops for a 3-year locked down period known as the designated period. So it's a longer term play requiring patience. The fund wants to hold about 100 stocks from the S&P 500. This means when some holdings are removed, they will have to replace them or rebalance. According to the filing, they are going to limit tracking error to the reference index. The filing also mentions that IT stocks are a significant component of the reference index. However, this may change over time. The fund isn't necessarily trying to beat the market, but rather to provide a certain level of income, even if that means the funds do less well. The fund also sells call options on stocks, which means that upside is severely limited. I guess we know why the word achievers isn't in the name. The main risk mitigator the fund will make use of is to purchase long-dated put options. It will act as an insurance in the event of a black swan event for investors who buy shares at the beginning of a 3-year period and hold shares until the end of the designated period. The extent of the benefit of the hedge to the fund will depend on the correlation of the fund portfolio to the reference index during the designated period. Now to address how will the fund pay its investors. The intention is to have an annual basis through dividend income and premiums from sold short-term call options. Each week, the fund will compare the dividend income of the reference stocks held by against the sum of the fund's target distribution combined with other required reserves and expenses. The fund will attempt to bridge that difference with the premiums that come from selling call options. Basically, the returns of stocks may change what proportion will come from premiums, from options, or from stocks. It's important to note that you can't just pull your money out whenever you want. The fund intends to repurchase its shares every 12 months after a predefined closing of a designated period, likely at the end of the 3 years. In other words, the best times to join are likely at the beginning of these designated periods. The catch, they might only offer to buy back a portion of your shares, or worse, may choose not to conduct a tender offer at all, so there's limited access to your money. Now it's time for the most important part of this filing. Let's take a look at the fund fees and expenses in order. Alright, now to the juice. How expensive is all this protection and income generation? Here is a quick rundown of this table. If you're in Class A, the sales charge load as a percentage of subscription amount is 2.0%. However, the sales charge load is none on Class I. It's not a lot, but still significant if you invested more. Repurchase fee as a percentage of repurchased amount is 2.0% for both classes. As a percentage of net assets, the unitary management fee is 2.65% for both share classes. There is a distribution and servicing fee, however, at 1.0% for Class A shares and 0.25% distribution fee for Class I, which means the total expenses as of net assets are 3.72% and 2.97% for Class A and I respectively. It is worth mentioning that they are only estimates that can be different. I team those high fees may mean that returns might not look as appealing after you pay those fixed costs. Those fees may not make a lot of sense, so here is an example. If I put in $1,000 and over 10 years with 5 annual return, I would pay almost $390 on expenses for Class A and $330 for Class I. Keep in mind this hypothetical section makes assumptions and the number may vary. The shares for this fund cannot really be sold to another person, but rather you have to wait a year to have an opportunity to sell back to the fund itself, so make sure you really don't need the money. Okay, to the risks, it is worth keeping in mind that the order does not indicate importance. The fund doesn't have a history of operations, which makes the fund harder to evaluate. Shareholders tendering shares for repurchase prior to that 3-year period will not fully benefit from the downside hedge. During economic downturns, the value of the assets could decrease. The fund uses leverage, basically using borrowed money with a hope to make more money than the cost of borrowing. However, there is more risk of loss as well. The fund intends to use derivative instruments, principally options contracts, which can increase the investment losses. Now, to touch more specifically the investment strategies, which might prove to be a bust. The fund invests in equity securities. Prices fluctuate for several reasons, some which include changes with investors' perception, market volatility. The fund strategy seeks to provide investors with a target net income of approximately 12% on an annual basis. But this may not be the case since the distribution can exceed the fund's profit, so there would no profit given to shareholders. Let's briefly look at the crew steering this ship. First Trust Capital Management LP is the investment advisor who oversees asset management. Then there's Vest Financial LLC as the sub-advisor who is in charge of strategy and day-to-day decisions. Keep in mind that FTCP, which is affiliated with the investment advisor, is the largest holder of shares in VG, the subgroup of sub-advisor. In terms of portfolio managers, Karen Sood and Trevor Lack are the people who manage how money turns into more money or doesn't. First Trust Portfolios LP serves as the placement agent. They're responsible for selling shares of the fund. This may create a conflicting relationship as their payment is related to the sales of shares. Now let's step back and reflect over this opportunity. On the positive, if you are an accredited investor, the appeal of this fund is clear. Downside protection with a relatively predictable income stream, and an attempt to provide a high return with an actively managed assets from the S&P 500 index, as well as some premium returns on selling options. The downside is the high expense ratio of pretty much 3% that is charged regardless of income, which will affect how much money you have in the long run, and the restriction to only sell back share annually, likely at the end of every 3 years when designated periods. Given its design, it's probably only a good fit if you know you want to lock away some cash for the long haul. All in all, it could help you get some good sleep at night, but the fees could eat into your meal along the way. What do you think? Is this fund a smart move in today's uncertain environment, or are there better places to park your money? Share your thoughts in the comments below, and don't forget to like and subscribe for more Corporate Decode deep dives. Check out too our Discord. It's a fantastic way to connect. Thanks for watching.